Equity market update. Indian equities saw a broad-based rally in FY24, resulting in total market capitalization surpassing $4 trillion for the first time. Consequently, India became the fifth largest equity market globally. Nifty and S&P BSE Sensex ended the year higher by approximately 29% and 25% respectively. Notably, mid-cap and small-cap indices significantly outperformed. Key drivers and events during the year included resilient growth in the US, the Israel-Hamas conflict, rise in oil prices, ongoing monetary tightening by central banks in advanced economies (AEs), volatility in US and European yields, disappointment in China's growth, robust domestic growth, and substantial government capex. Most sectors ended the year with strong gains, with utilities, capital goods, auto, healthcare, and oil and gas as the key outperformers. Globally, most equity indices across advanced economies (AEs) and emerging market EMs experienced gains, except for China and Hong Kong. In FY24, foreign portfolio investors (FPIs) turned net buyers and bought equities worth $25.3 billion, FY23 net seller of $5.1 billion. Domestic institutional investors (DIIs) stayed net buyers, purchasing equities worth $25.3 billion in FY24, FY23 net purchase of $32.2 billion. Flows into mutual funds (MF) remained steady, reaching approximately INR 230,000 crore in 11 MFY24 and approximately INR 210,000 crores in 11 MFY23. Key trends of FY24. Broad-based market rally led by small and mid-caps. Returns from mid and small-cap stocks outpaced that of large caps. The market capitalization of top 100 stocks as percentage of total market capitalization fell to approximately 62%, below the 20-year average of approximately 70%. Post this rally, mid-cap and small-cap returns vis-a-vis large caps is substantially higher in both near and long-term time frame. Corporate profitability remains robust. Corporate profitability of listed companies improved, driven by rise in profits in the energy sector, oil and gas, power, coal, banks, and the automotive industry, etc. This positive trend has outweighed the subdued performance observed in IT and metal sectors. The corporate profits to GDP ratio, TTM up to December 2023, climbed to approximately 5%, marking the highest level in the past decade. Rising participation of retail investors. Retail participation in the equity market surged in FY24. Systematic Investment Plan (SIP) flows, a proxy of retail participation, has been consistently rising post-pandemic, and average monthly gross SIP flows have doubled in last 3 years. Total SIP AUM now forms approximately 35% of the assets under management AUM of the mutual fund industry for equity-oriented schemes. Moreover, this expansion in retail participation was widespread, with a sharp increase in number of folios. Consequently, the ownership of mutual funds (MF) in Indian equities increased to 9.2% as of December 31, 2023, compared to 7.7% on December 31, 2021. Outlook. As on March 31, 2024, Nifty 50 was trading at approximately 20.7x FY25E price-to-earnings multiple. In addition, market cap to GDP stood at approximately 105% based on CY25 GDP estimates, and the gap between 10Y GSEC yield and 1Y forward Nifty 50 earnings yield remained at elevated levels. Thus, current valuation multiples are at premium to their historical averages. However, one should view these valuations in the context of structurally attractive nominal GDP growth, a healthy corporate earnings outlook, and robust delevered corporate and banking balance sheets. Valuations for most major sectors are higher than their long-term averages. The sharp equity rally in the current financial year has resulted in small-cap and mid-cap indices significantly outperforming, and they now trade at a noteworthy premium to their historical valuation, as well as that of large caps. Given the aggregate valuation being higher than historical average, the importance of stock selection increases even more. We remain positive on equities over the medium to long term, considering the structurally robust domestic growth outlook, healthy corporate profitability, and pro-growth policies. A sharp slowdown in global growth, escalation of geopolitical tensions, and re-acceleration in inflation globally or locally are key near-term risks. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.